Thank you for watching this video. Today we will be doing technical analysis on the stock market for the week ending Friday, November 6th. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals is like having Risk Radar for the U.S. stock market. Let's start with Friday, November 6th. So just today's trading, and today on Friday, November 6th, we were down 3 basis points on the S&P 500. So basically flat, but you can see here for the day on this 1 minute one-day chart that we're going to start with. We sold off early into the morning and just before 10 a.m. hit the lows of the session, and then about 11 o'clock, went positive just before 11 o'clock, and then from there we just kind of traded sideways with a little bit of chop, and you can see here we finished up just barely negative for the day, again down 3 basis points, closing the week at 3509.44. The next chart that we're going to look at is a 4-month weekly candlestick chart of the S&P 500. So each candlestick does represent 1 week of trading on this chart. The blue line is set at 3510. The importance of this is that you can see that on the weekly closes, right, we've never had a weekly close above 3510 on the S&P 500. We, of course, have had daily trades above 3510, but on a weekly basis here, you can see that we have not yet closed above 3510 on the S&P 500. And this weekly close of 3509.44 was the highest weekly close ever in the S&P 500. The prior weekly closing high was 3508.01, and that was right here on the week that began on August 24th and ended on August 28th. So that's this candle here. So up until today, this week, that was the highest weekly close in the S&P 500. But we had an incredible week here, as you can see. And by the way, we were up 7.32% for the week on the S&P 500. It was an absolutely stellar run this week. And guys, and especially those of you that are newer to investing, or maybe you're paying more attention to investing now than ever before, these types of weeks are extremely rare. Okay, so don't think that this is going to happen very often, because these types of weeks are absolutely rare. They're fun when they happen, but keep in mind that the long-term average annual return of the S&P 500 going clear back to 1970 is about 10% a year. So with a return of 7.32% in 1 week, that's 73%, right, of the entire average annual return of the S&P 500, and we got that in 1 week. So just keep in mind that we should not expect those types of returns during a given week very often. The next chart that we're going to look at is a 5-year weekly candlestick chart of the S&P 500. You can see the green line is the 40-week moving average. Of course, that's equivalent to the 200-day. And I just wanted you to see here that with this weekly return of 7.32%, we're once again quite elevated above the 40-week moving average. But keep in mind that 3510 has been, so far on the weekly closes, an overhead resistance point. So, the question becomes, next week, can we close above 3510? So on a weekly basis, can we get above that and stay above that on a weekly basis, or are we stalling out once again, as we did here? And any of you that have been watching my videos for a while, I warned you back here that it looked to me like we were stalling out, and that's what preceded, right, this sell-off here. So the question is now that we've come back up to this level and had a slightly higher closing high this week, can we get above 3510 and stay above there on a weekly closing basis within the next week or two, or are we once again going to stall out at this 35.10 level. Guys, there's no way for any of us to know the answer to that question right now. I mean, eventually we'll get above it, right? Over time, the market goes up. But the question is, in the short term, are we once again stuck here, or did we just stop here this week and, maybe next week or the week after we close above 35.10 on a weekly basis? So we'll have to keep our eye out for that. And then the triple Qs had a huge week this week as well. The NASDAQ 100 up 9.37% on the triple Qs. And again, you can see that we're quite elevated above the long-term moving average on the triple Qs as well. And then small caps also had a really nice week this week, up 6.85% on the small caps. Obviously, you can see that the tech stocks, the large cap tech, and even the overall S&P 500 still outperformed small cap, but at least small cap had a decent week. And you can see that the IWM, which is the ETF that tracks the Russell 2000 small cap index, is now well above its long-term moving average. And the good news is this long-term moving average, this green line here, the 40-week, had been going down. Okay, that's not good, but we're starting to see that thing flatten out. So that could be a good sign that we're starting to see some upward momentum in the long-term momentum in the Russell 2000, the small caps. That could be very good for the stock market going forward. But just keep in mind that the Russell 2000 peaked in August of 2018, so over 2 years ago, and we came right up to that area but couldn't quite make a new high in January of this year, right here, and of course, here we are. So with this type of a week, 6.85% on the small caps, can we continue to go up from here, or are we making lower highs? These are just questions that you have to ask when you're doing technical work. But, hopefully over the next couple of weeks, we can come back up to this and perhaps make an all-time high in the Russell 2000. If that happens, that will be a very bullish sign, potentially anyway, a very bullish sign for the overall stock market, because keep in mind, the stock market is going to be healthiest when all capitalizations are working in tandem, not just large cap, which unfortunately is what we've seen over the last couple of years, where we've seen large cap responsible for the majority of the returns in the overall stock market. And if you're not yet a subscriber to Simple Market Signals, I want to invite you and encourage you to take a serious look at what I do. Simple Market Signals is my personal risk management model that took me over 20 years to develop. And after I started working with it for a while, it finally came together in 2017. I realized what I had, and I realized a lot of people could benefit from this information. And so I created a business around delivering the exact same signals that I use to help manage my risk in the overall stock market, right? It's stock market risk management, which is something that most people don't pay that much attention to, guys, but I'm telling you, it's super important, because 70+% of all stocks go in the same general direction as the stock market. So if you're not paying attention to stock market risk management, you are missing a critical key in being successful in the stock market, whether you're trading individual stocks, in stock options, ETFs, mutual funds, whatever it is, the overall stock market or individual stocks. You really need to understand what direction the overall stock market is going and where the risk levels are. And so it took me over 20 years to figure this out, but I have a model that really helps, and I share that information with my subscribers. So with that said, at this time, I'm going to tee up a little bit more information about Simple Market Signals. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market. And I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over and that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, and it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an emailed newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, Okay, understand that everything is tied to your email on file. All right, so once you subscribe, you go out to the website, simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy, and you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information, and you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend. All right. So the goal is to get it out Saturdays by 2 p.m., but it could be any time over the weekend, depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition, right, once you subscribe, understand that the next edition, right, so if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday. All right, and then once you subscribe, we will send you as soon as we can the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders. Because it's probably hidden in there. All right, so you should get the automatic welcome letter, and then the latest edition within the next day or two of your subscription, and then again the standard newsletter goes out every weekend. But we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.